We are talking about qualified dividends today, what they are, how they affect your taxes, and who might be interested in them. Chris, how you doing?
I am feeling qualified to talk about this topic today.
Oh yeah, I guess you are a little bit.
I don't know. That sounds a little pretentious. I was trying to get the pun in there. Qualified, you know.
I think that most people that are watching this show know that you're pretty qualified to talk about most of the things that we talk about, unless I try to make you veer off into crypto or something.
That's fair. No, I'm good. I'm excited to talk about this topic.
Awesome. So am I.
Yeah, I mean, you and I discussed, we've touched base on qualified dividends and dividends in general in the past to our listeners.
In passing, yeah.
Yeah, episode 18. Now we're cooking with dividends. I laugh when I see that title. I still remember why we made it that title.
I don't know.
But
we just choose whatever title we want most of the time.
Cooking with dividends. Maybe we have to get in the food business. We'll create a butter or something. It's called dividend butter or something. And
Dividend butter.
yeah, cooking with dividends. Anyway, that one fell short. So
Yep.
no, but qualified dividends. So Danny, I mean, you and I have talked about the recent, I don't know how recent, past few years, phenomenon of people getting more and more interested in dividend investing.
Very true.
Yeah, it's very much in vogue. And again, to our listeners, in episode 18, we do deep dive a bit into dividends in general. And Danny, you and I talked about some of the pros and cons, and we also tried to be fair and middle of the road. We dispelled some myths about dividends in general that people get really confused about, and sometimes there is some misleading and maybe a little over-exuberant excitement about them that isn't always warranted.
Exactly.
But qualified dividends, as you said, they do have a special place in the tax structure, if you will. Surprisingly, most people who are invested in the markets, primarily US, but also international, they probably don't even realize it, but they're very likely receiving some form of qualified dividends if they've been holding their holdings for an adequate amount of time. But yeah, I say we dive in and let's talk about it. Let's go through what it is, pros and cons. How does it affect taxes? What are some who might be good for, like you said. We might even get into some, qualified dividend strategies, if you will.
Yeah, some niche dividend planning strategies.
Yeah.
I can speak to some of these as well.
Yeah, nice. So,
For sure.
Yeah, so what is a qualified dividend? Well, first, a dividend, again, back to the basics, it's just a distribution of earnings to shareholders, right? So company earns profits for the year. They can do all sorts of things with those. They can pay down debt. They can buy back stock. They can merger, acquisition, research, development, invest in the company, buy other companies, right? Or they could pay a dividend to shareholders. It's a way to reward shareholders by paying cash out to them and to help them participate in the profits of the company, if you will. Depending on how long you've held the dividend will determine, and a couple other factors, will determine if it's an ordinary dividend or a qualified dividend. So qualified dividends, the cool thing about them is they are taxed at the long-term capital gains rates, which are 0%, 15%, and 20%, depending on what income range you're in, compared to ordinary income tax brackets, which are 10, 12, 22, 24, 32, 35, and 37. I mean, Danny, you know this, but there's a very nice bandwidth of space of income you can earn in long-term capital gains rates while it's in the 0% tax bracket, right? Before you even dip into the 15.
Particularly if you're married filing jointly.
Yeah. Yep, exactly.
Yeah.
So,
and those preferential tax rates are the reason that so many of the upper earners, let's say higher earners within the country, invest in assets, right? Dividend producing assets or any kind of asset that can be taxed at the long-term capital gains rates will yield you a much lower effective tax rate at the end of the year.
Right. I mean, for comparison's sake, the top tax rate for long-term capital gains rates and also for qualified dividends, if you will, is 20% compared to ordinary income, which is 37%. That's the top tax bracket for ordinary income. Now, when your income gets above a certain threshold, when your modified adjusted gross income gets too high, portfolio income, things like capital gains and dividends, can trigger something called a net investment income tax, which is an additional
net investment income.
Yeah, NIIT. And it's an additional 3.8% taxation. You really have to get above a pretty high dollar threshold, though. So
It's honestly a pretty nice problem to have.
yeah, but even if you're hitting that with qualified dividends, right? The max tax rate you're looking at is 20% plus the 3.8%, so 23.8%. Now, of course, you might also owe state income taxes and things like that, but we're just talking about federal here. So even with that 3.8% net investment income tax, we're still looking at a comfortably lower tax rate at the long-term capital gains rates, of which qualified dividends are included, when compared to ordinary income tax rates. Now, before we go any further, forgot to say this at the beginning of the episode. Nothing in this episode today should be considered financial advice or tax advice. We're doing this for entertainment and education purposes only. We're speaking very broadly, high level about tax concepts and whatnot. Please understand to our listeners that your personal situation is just that, personal and unique. And I guarantee you what we talk about today is probably not going to map over to your exact tax reality. So please seek the help of a tax professional. I want to throw that out there. But of course, disclaimer aside, we're doing this because we want to educate you and give you more knowledge in your tool belt to use and to be able to make better informed decisions about what's actually happening in your portfolio. So just wanted to throw that out there. But moving back to the topic, qualified dividends. We know they're taxed at long-term capital gains rates. How does that happen? What do you have to do to make sure that your dividends are qualified? Well, I'm going to invite our listeners to Google some of the finer nuances of it. But broadly speaking, again, you might want to deep dive and research this, but broadly speaking, qualified dividends, the dividends are qualified if it's a U.S. company or qualifying foreign company. Also, if it's a company that doesn't show up on the IRS list that states it isn't qualified. And if your personal holding period is met, the holding period requirement is met, which is, I believe, more than 60 days within 121 days of the ex-dividend date.
Which is getting a little bit technical.
Yes.
But one of the things I had said in a previous episode that I would refer to is, if you are a buy and hold investor, then you are most likely going to be hitting all of these requirements for the holding period for qualified dividends and long-term capital gains rates.
Yeah, I mean, I think for a lot of people who are buying, broad index funds in the U.S. market, whatnot, and they're holding it for, an adequate amount of time, just kind of investing, every paycheck or dollar cost averaging and not really selling their position, just accumulating over time, you're very likely hitting those qualified dividends. But it's just good to be mindful of, right? If you are purchasing things and you're wondering if your dividends are being treated as qualified dividends, those are some of the high level qualifications. Definitely invite you to go maybe look some of it up online. There's a lot of good information there if you want to deep dive more into it. So we've touched base a little bit, Danny, on the taxation of qualified dividends, but we did say, of course, that they're taxed at long-term capital gains tax rates. But I do want to clarify, qualified dividends are not capital gains. And they're not long-term capital gains. They are still technically considered ordinary income. This is important because as you fill up your tax bucket, right, it first starts with ordinary income taxes. That ordinary income fills up your tax bucket, fills up your tax rates, if you will, and then capital gains come in on top. I'm way oversimplifying this, but it's essentially the reason this is important, where I'm going with this, is you cannot harvest like long-term capital losses, for example, from your portfolio and use those losses to offset qualified dividends, so you don't have to pay tax on those dividends. So that's where I was going with that.
Yeah. Okay.
Yeah, and I should also say, probably should have planted this flag earlier on, but better late than never. We are specifically talking about a taxable brokerage account, like a taxable investment account.
Correct.
If you have an individual retirement account, something that's qualified monies and is tax deferred, well, it's not really going to matter what your dividends are, ordinary or qualified, whether you're paying ordinary income tax or long-term capital gains tax rates, because it's just tax deferred. And, so that doesn't apply to this conversation. So for the context of today's conversation, we are talking about just regular taxable brokerage accounts. They're not retirement accounts. Yeah. So Danny, I've got want to quickly read through some of the brackets here. If you're looking at a single person, basically the 0% long-term capital gains tax rate for the 2024 tax year, this of course is going to change next year, but $0 to $47,025 is the 0% long-term capital gains tax rate. For reference, 0 to 11,600 for a single person is a 10% tax bracket, and 11,600 to 47,150 is the 12% tax bracket. So
For ordinary
yeah,
income.
correct. So we've already filled up two buckets, two tax brackets, and we're still at the 0% tax rate for long-term capital gains, right?
That's very nice.
Yeah. So then it jumps up to 15% when you get to 47,025 all the way up to 518,900, which is huge, right? So
15% for the vast majority of the entire country.
yeah, for reference, if you're making $500,000, if your taxable income is $500,000 for a single person, you're in the 35% tax bracket, so 20% higher than the 15% long-term capital gains tax bracket. Now, again, we're talking very simplistically here. There are all kinds of nuances that come into play, like your total income less your standard deduction or your itemized deductions, whatever is greater, gets you your taxable income. And we're not trying to get into the nuances of taxation. That's why I gave the disclaimer earlier. It's like we're talking high level here, but it's cool to point some of this out so people conceptually can understand, like, okay, there are these two types of tax rates. There's ordinary income, there's long-term capital gains tax rates. And I also understand conceptually that the bandwidth, the amount of income you can earn within long-term capital gains tax rates is pretty wide before you get to the next bracket. Whereas in ordinary income, they're much smaller bandwidths, and you're kicking up in the tax brackets over there. So I just high level talk about this because it just emphasizes that, hey, this is a little bit more advantageous taxation being applied here compared to ordinary income tax rates. So it can be motivating to be aware of that, right? So you know how that fits into your own tax picture. So
absolutely,
yeah. So
it's that taxation is one of the things that always has drawn me towards dividends. I think it's very encouraging that you could receive in qualified dividends, what is essentially a very frugal but comfortable lifestyle for some parts of the country with zero taxation. And again, this is very generalized.
Yeah, I mean, yeah, in theory, and we'll actually touch on this a little bit.
This is all in theory.
Yeah, we'll touch on this in some of the strategies, but in theory, if you had absolutely no other income sources, no income from a job, your spouse didn't have income from a job, you weren't earning interest in a bank account, you weren't collecting royalties or social security or pension or annuity or any truly, literally no other income sources, all you had was qualified dividends, you could have a pretty nice chunk of qualified dividends before you'd ever have to owe taxes, right?
Yeah.
Which is kind of cool. But yeah, one thing, Danny, you actually pointed this out in a prior episode. Actually, you've emphasized it a couple times, and it's worth saying. A company or a fund pays a dividend to you. You are still going to have to pay taxes on it, even if you don't take it as cash. Even if you just reinvest that dividend right into the same fund or company that you are investing in, that is still a taxable event, even if you've never received the cash. So just remember that. Some people still get shocked.
It's something the IRS, calls constructive receipt. Where if you theoretically had control over the money, over that capital, then you are responsible for paying taxes on it.
Yeah.
Because you had the choice to either receive it or to have it reinvested.
Yep. That's well said. That's worth keeping in mind that if you are in the accumulation phase and you are not benefiting from those dividends as income to use for your living needs, you're just reinvesting it, you're still going to have an ongoing tax liability, right? Most
within a taxable brokerage.
Correct. Yes. Yeah. And most dividends pay out quarterly, 4 times a year, in most equity holdings, stocks and mutual funds, ETFs, things like that.
The majority would be quarterly.
Yeah.
There are different funds and different companies that focus specifically on paying monthly dividends. However, one of the other aspects with the focus of a lot of those companies is on generating income. And most of the time for most of those monthly companies, those monthly paying companies, that is paid out in the form of ordinary dividends, which are taxed at ordinary rates.
Right. Yeah. I mean, mostly it's quarterly. I will say on the flip side of that, so we talked about monthly and quarterly. I even have international holding that pays dividend twice per year as opposed to 4 times per year. So
I've seen once per year. It's just a lump sum at the end.
Yeah.
Yep.
Yeah. So I guess it just depends on the specific fund or company too. So it's a good shout out. Be mindful of how often your dividend posts, right? Like that could be a consideration, especially if you're planning to use them for supporting income, right? We're used to paychecks every 2 weeks, right? It might be a little bit of change of pace if you're
Yeah,
switching
it
to
might be
every
exactly,
four.
let's say that someone was being paid weekly,
Yeah.
right? That is a thing with many employment situations. And you go from being paid on a weekly basis and managing those small chunks of money to receiving a very large chunk of money every 3 months, every quarter,
Yeah.
and then having to balance that out for the next 3 months, the next 90 days or so.
Yeah. Well, I should say a large chunk of money, assuming you have a nice nest egg that's producing
Well,
a
yes.
dividend.
Yeah.
But yes, yeah, it's a good point to be mindful of. So, nice. Well, Danny, let's jump into some dividend strategies, right? Like, I think this gets into who this might be good for, right? If any of these things we talk about appeals to you and your personal situation, and if it makes sense for your situation, then maybe you consider exploring and seeing what dividends might offer your portfolio from a diversification standpoint or whatever it might be. I think the first one is asset location, right? If you are using dividends, or well, that's a funny way to say that. 'Cause most people who invest in the stock market probably have some form of dividend coming in, even from just a broad index fund. But assuming you have, you're specifically focusing on, you've carved out a small portion of your portfolio where like, I'm going to focus on dividends in this area. Well, we've already alluded to something, Danny, which is if you are going to have some pool of assets that are paying qualified dividends, it may be appropriate. And let's say you've said like, based on my overall diversification and my allocation based on my risk tolerance, I would like X% of my portfolio to be carved out to focus more on this qualified dividend play, if you will. Perhaps if you were carving out a small place in your portfolio for that, it would be best to silo that specifically in a taxable brokerage account and not in an IRA, because
I agree.
like in an IRA, you're not going to get the benefit of
Yeah.
the taxation of a qualified dividend.
In an IRA, you are, theoretically or hypothetically focusing on long-term growth for your future retirement needs. I do have a taxable qualified dividend portfolio. We've discussed it in the past.
Yeah.
And I have angled that towards specifically qualified dividends because it is taxable now, right? Each year that income is received, I pay taxes on it. And I am, as I build that up, making sure that everything that I am buying into is focused on qualified dividends to take advantage of the long-term capital tax rates.
Yeah. Yeah. And I mean, you're happy to just kind of manage the taxes each year as you go on, right? I mean,
Yes.
because they're not ordinary income taxation, they're long-term capital gains rates. And, that's kind of the trade-off, right? It's like you're deliberately recognizing that, hey, I'm going to have to pay taxes on these, but there's intention behind this. We know it's at a slightly more advantageous tax bracket. So maybe you could even say it's like part of your tax diversification play, right? Like you don't know what your tax bracket's going to be in the future. And as your income increases in the future, maybe more sources of income that you currently have are going to be subject to even more taxation. And so maybe this is one way to start paying some of those taxes now in an advantageous bracket, which helps kind of ease some of that tax burden in the future. And it's worth mentioning, Danny, on this, if a qualified dividend pays out and you reinvest it into that company, well, that becomes part of your cost basis, right? Like you are
raising that basis.
Yeah, you're raising your cost basis. And to our listeners, in case you're not sure what that is, if you invest $10,000 into some type of investment and it grows to 20,000 and you sell it, your cost basis is 10,000. It's the original principal capital you contributed. And so your sale price, what you owe taxes on, is the difference between the sale price and your cost basis. So if you think about that, every time dividends are paying out, if you're reinvesting those, that's new little bits of principal capital that you're reinvesting. And so that gets added to your cost basis. And so you could say you're just incrementally increasing that cost basis over time with hopefully advantageous tax rates, right? And that might mean your future tax burden, should you ever need to do a really big asset sale. Maybe you've shrunk the distance between the total price that your holding has appreciated to and the cost basis that you've been incrementally increasing over time by reinvesting those dividends. So just another thing to think about. Back on this asset location strategy, this is further emphasizing why it's advantageous to put some of these in a taxable brokerage account. If you have international holdings that pay dividends, you will often see that dividend pay out, and oftentimes the broker will withhold, or there will be some type of tax withholding for the foreign country, right? Sometimes there's even a fee, but you're also having to pay taxes in the US, right? Because you recognized income. So to help mitigate some of that double taxation, if you will, a lot of international dividends are sometimes eligible for the foreign tax credit. Again, speak to a professional. I'm not going to go into detail on what that is,
Yep.
but you are not generally not eligible for a foreign tax credit if those international dividends are being paid out in your retirement account, like an IRA.
I do have a few international dividend paying equities, and I have been able to take advantage of the foreign tax credit.
Same here. Yep. I also have an international holding that pays dividends, and I was able to take advantage of the foreign tax credit. So something to be mindful of. Another reason why you might hold them in a taxable brokerage account instead of a IRA. Another one, Danny, this is actually something I've heard on YouTube from some finance gurus.
I can't wait for this one.
The 0% tax bracket. Like some people call it getting to zero. Like you'll hear some people talk about
the 0% tax bracket strategy.
Yeah. So
okay,
some people plan so that when they get to retirement, they have set up everything so that they're virtually having zero taxation. No income source is showing up on their tax return. And if there is an income source showing up, they're doing it strategically in a way that it's hopefully being not taxed at all. So this is very likely some hodgepodge combination of like Roth IRA distributions, qualified distributions, which are not taxable and they don't even show up on your tax return, and they also don't affect your AGI or MAGI. Some people use life insurance cash value policy loans. Some people use reverse mortgages. Some people will just withdraw basis, right? They'll have certain assets where they're withdrawing basis and not touching the gains, or selling assets with the lowest gain possible. It gets really complex. Qualified dividends could also fit in this theoretical strategy. I'm not promoting a 0% tax bracket strategy. I think it could be hard to actually pull off depending on how things...
And very likely requires starting planning many decades beforehand to make sure it all works out properly.
Right. But as we discussed, right, a certain bandwidth of long-term capital gains or qualified dividends is taxed at a 0% rate. And so in theory, you could, I don't know, maybe throttle how much income you're recognizing from qualified dividends or something, like staying within those bandwidths to not be taxed.
And on a smaller, like a more mild version of this, right, the less serious side would be the previous concept we've discussed of having, like you said, taxation diversification, right, or tax diversification, where you have your taxable bucket, you have your qualified retirement, like 401k bucket, you have your Roth bucket, you have these different buckets that you can pull from as needed in a specific year to try and meet specific income and taxation goals.
Well said. That's kind of a unique concept, right? What you just alluded to, having these different buckets that are, taxed in different ways, and being able to have the flexibility to pull from whichever one is most advantageous in any given year based on your taxes. A lot of people are proponents of that, right? Like you and I have admitted in the past that we very much love Roth accounts. And I admit that bias.
Just a wee bit biased.
I admit that bias. I love Roth. I also acknowledge it's not necessarily the one size fit all perfect strategy for everybody.
Absolutely.
But I have met people. I remember talking to someone. This is a slight tangent to our listeners. Apologies, but it is really cool. And I think it fits into the theme of the conversation today. So I was talking to somebody a few years back, and it was a financial analyst, a CFA, chartered financial analyst, really smart guy, amazing investor. In his income level for the year, I was kind of talking to him about it, and when I was kind of getting a high level picture of what his income was going to look like for the year, and I knew like the next year it was going to be, or maybe not the next year, but in the near future it was going to be jumping up. I remember saying something like, you might want to consider just like changing your allocation to 100% Roth for the foreseeable future until tax brackets go up. I think that was part of it with the sunset coming up, right? And tax rates going back up starting January 1st, 2026, assuming nothing happens between now and then. And he put his foot down. He's like, you know what? I understand the logic, but I just feel more comfortable from a tax diversification standpoint by doing 50-50, 50% Roth, 50% tax deductible, because I
Okay.
just don't know what's going to happen. And
Sure.
I'm willing to hedge that. And like, yeah, maybe I miss out on some advantageous Roth, or maybe it ends up being more advantageous to have gone one way or the other. But by splitting it down the middle, that's just how I feel. And I was like, okay, interesting.
Yeah.
So
I mean, if it's less stress now and you're comfortable with, playing that out in either direction at, during retirement, then more power to you.
yeah, and I could see somebody applying a similar logic to this situation with qualified dividends. So maybe somebody's really, really young, right? And like 18 or young, or maybe young 20s, right? And they have multiple decades, 40, 50 years ahead of them of investing. And so maybe they're thinking like, oh, I should probably just be like in high growth assets. I should just go growth. They might also say, you know what? I don't know what asset pool is going to outperform over the next 3-4 decades. So I'm just going to take a diversified approach and take the tax diversification along with it by having some things in growth, some things in value, some things that pay qualified dividends, some that don't pay dividends at all, and they're just focused on reinvesting into the company. It's just part of the diversification conversation. And I think there's a way to rationalize how these things might fit for your situation. And so I know we're having kind of just a casual conversation about it at this point, but I think some of it's illuminating. I think these are things people could be thinking about when addressing these topics and trying to make a decision. What do I do? That's not always easy to answer.
Okay.
So
That makes sense.
yeah,
So, kind of steering back to the 0% tax bracket strategy
Yeah.
that we had kind of got lost in the weeds.
yeah,
You had mentioned one thing about how this relates to Social Security in some way.
oh yeah. So no, that was just a minor thought I wanted to add, where we know that in theory a certain amount of qualified dividends could be paid and be in the 0% tax bracket, assuming you had no other income sources whatsoever. But
Okay.
if somebody wanted to do that in retirement, I could see a potential hiccup with this strategy. Like somebody sitting here might be thinking like, I know what I'm going to do when I retire. I'm just going to have everything in like high quality companies that have amazing track records of conservatively run companies and paying consistent qualified dividends, over the years. And I'm just going to live off of qualified dividends and pay 0% in taxes. Probably not going to work out that way, because at some point you're probably going to claim Social Security, right? And even though qualified dividends are taxed at long-term capital gains tax rates, and potentially that rate is 0, qualified dividends still do show up on your tax return and increase your adjusted gross income, AGI.
Okay.
That also increases your modified adjusted gross income for the purposes of taxation of Social Security. So you may be earning qualified dividends at a 0% tax rate, and maybe you were expecting that you would not owe taxes on Social Security income either, but you may inadvertently trigger taxation on Social Security if you were doing a purely qualified dividend
Okay.
and Social Security only approach.
Yes.
So
you could be receiving qualified dividends. You're paying 0%. You're in that 0% qualified dividend or qualified long-term capital gains rate,
Mhm.
right? That 0%.
Yep.
However, that qualified dividend income is still raising the watermark. It's still filling those buckets in those brackets, even if you're not having to pay on it.
Correct. Yeah.
And so filling those buckets, eventually you hit those phase out limits for Social Security, and then you start paying tax on up to 85% of your Social Security benefit.
Correct. Yeah.
Okay.
Yeah. And to our listeners, what Danny just said, it's not an 85% tax rate on Social Security. It's up to 85% of your Social Security benefits are subject to taxation.
Yes.
Which, if you actually think about it, as a quick aside, is pretty cool. Like,
Yeah, it's still a benefit.
Yeah.
Like you don't have to pay taxes on 100% of your
like you do
benefits.
with your job, right? Like, here's a source of income where you only have to pay taxes on 85% of it that's subject to income, subject to taxation. So I go through that example about, you know, the triggering taxation of Social Security, because this goes back to, again, the disclaimer we gave about not tax advice. This is yet again another one of those examples, and there are hundreds of them. We would never be able to explain them all. But taxes are so complex, and so many moving parts are occurring at every given time. And one lever pulled over here is going to affect something else over here. And that's why we talk about these things high level for educational purposes. And yes, there are benefits you can derive from careful planning around some of these things that could help with your overall tax planning. But some people get a little bit too carried away with thinking they're going to be in this incredible situation, paying no taxes whatsoever. And again, I want to. That's why I'm putting some guardrails up here, because yes, there are benefits to qualified dividends from a taxation standpoint, but you have to be mindful of how those things intersect and interact with other areas of taxation. So just throwing that out there. One quick call out, Danny, and we're not even going to go into this, but to anybody out there who happens to be a tax nerd, qualified dividends do retain their long-term capital gains tax bracket treatment, even if one is subject to alternative minimum tax. So,
okay, the alternative minimum tax system, I'm going to call it right now. We are not diving into this, but I do have an interesting little fact.
Okay.
This is a separate kind of secondary tax system that runs in parallel with our current tax system. Here's the interesting thing. Created in 1969, it was originally created to ensure that a very small group of very wealthy people were paying taxes. And it was something like 200 people were intended to be captured by this new alternative minimum tax system. They did not index it for inflation, which means that more and more Americans with each passing year are getting caught by this system.
that is
When it was created to ensure that something like 200 households were paying taxes.
Oh my God. That is hilarious. I did not know that.
Index things for inflation.
Come on, people, please. Index your freaking things for inflation already. Wow, that's hilarious. I was laughing so hard, like I'd not heard that story. Thank you for that amazing history lesson on the AMT. So, well, fun side note, when the Tax Cuts and Jobs Act passed and it lowered tax brackets, part of that tax law change, which has been in effect since 2018, and we're still in that tax law right now, it increased the AMT thresholds massively, like big time. And so it's really funny. The amount of people who filed taxes and were subject to alternative minimum tax in 2017, in 2018, the number of tax returns the IRS received that were subject to AMT utterly plummeted. Like it is very much not much of a concern for people under the current tax law. However, if the sunset provision occurs, which it is scheduled in law to do so, unless something happens between now and the end of 2025, starting January 1st, 2026, we're reverting back to the old tax law. So people will start to see AMT creeping in more often and start affecting more people. You still have to be pretty high income, but it will affect more people at that point. Maybe we'll do an episode in a couple of years, Danny, if and when that becomes an issue.
Yeah, if we think we could possibly talk through the details of that, within an episode and have people follow along. I don't know.
Yeah, I'll might put people to sleep. That will be the episode we add to the sleeping app that we're building.
Perfect.
Yes. Yeah.
In the works.
Works. Yeah. It's going to be financial whispers in your ear about financial topics to put you to sleep. And that's going to be episode number 1. So, okay. Last one I wanted to say, Danny, this is one that you really, it's so simple in concept, but much like other simple things in life, we often take some of the profound, simple things for granted, right? Like we just don't give ourselves the time to appreciate something that is meaningful. And here it is. With a dividend strategy, you can turn on and off income when you need it. That's it. Sounds simple, but
let's complicate it. There's a caveat there.
Yeah, go for it.
You can turn it on and off in terms of receiving the cash and using that to pay for your living expenses. You cannot turn on and off the taxation of it if it's within a taxable brokerage, you are still going to be paying taxes on that.
Agreed.
Depending on your long-term capital gains brackets.
Yeah.
So there is that switch there for turning it on and off in terms of receiving it and using it for your day-to-day living expenses.
Yep. But let's riff on this for a second, because to our listeners, that there is more than meets the eye here with just how cool this little subtle nod to flexibility is, right? So let's say you have some portfolio holdings that you really love, right? And they've been paying qualified dividends for years to you, right? You've built up a position and you have these dividends paying out. Now you can decide, do I need to take this dividend to help pay for some income? Do I have a bill coming up? Do I want to knock off some of this debt I want to pay? Do I have some type of future expense on the horizon I need to prepare for? Cool. You know what? Turn off the dividend reinvest button and have the dividend pay as cash to your brokerage. It'll sit in the cash account. You can transfer it to your bank and you can spend it, right? You can use it for your living needs. Maybe you don't need it anymore. You've gotten past the expenses that were on the horizon. You knocked out a debt you wanted to take out, whatever it is. Great. You don't need it. Turn the dividend reinvest back on if you want and not have to worry about it.
Just use it to buy shares.
Right. If that's what you want to do. Some people still prefer it to pay out in cash and then just buy shares from that. So because certain things may be appreciating or depreciating in asset price on your holding. And so they might want the flexibility to overweight more towards one position or the other, right? Rather than just having it reinvest into the exact same holding. Maybe that holding is overvalued or it's had a big run up and you're like, maybe this dividend could be better allocated elsewhere. You can still reinvest it if you take it as cash. But the concept we're trying to say here is, look, you have this flexibility to kind of turn it on and off, access the income when you need it, and reinvest it into your holdings when you don't need it. And, it might not just be when you need it too. It might also be that you've been taking some of the dividends as cash and using it, but then the market has a really big pullback and that dividend rate goes up really high as a result, right? Because a dividend rate, as you'll know this from episode 18, Now We're Cooking with Dividends, we talk about this. Dividends aren't declared as a percentage. They're declared as a dollar amount. The percentage that you see, 2% dividend, 3%, 4%, is really just incidental to the dividend declared as a dollar amount divided into the current share price, right? So if a $100 share price of a fund claims a $1 quarterly dividend, it's going to pay out $1 for the upcoming quarter. And there are 4 quarters in a year, you would do 1 times 4. So that's a 4% dividend. Well, if that $100 share price increases to 200 and the dividend hasn't changed, you would see that 4% drop to a 2% dividend, even though they're still paying that same dollar dividend. So in your mind, you might be thinking, oh my gosh, well, my dividend just got cut. Well, no, it didn't. You're still paying the same dollar amount. But I give this example to highlight something, which is maybe that dividend yield has come down percentage-wise because the share price has appreciated handsomely. And so you've just been taking those dividends as cash and not reinvesting them because maybe you're thinking, well, the share price is pretty pricey right now. I could just reinvest, but maybe I'll take the dividend as cash and spend it towards a debt or something like that instead. Well, maybe that share price comes down because there's a market pullback and you've been taking the income and now you're thinking to yourself, ooh, this might be a cool time to just stop taking this dividend as cash and start reinvesting it while the asset price is down. Might be a good time to buy low, right? So I know this is elementary and basic, but I do think I don't think this gets enough attention. I think this is a unique, you can't do that with funds that don't pay dividends that are just all growth, right? You're just kind of at the whims of price movement, right? Whatever the price movement is what it is. But dividends,
nor can you do that with something that pays a fixed income like an annuity, where you are going to receive the exact same amount every month. You can rely on it. It provides that floor, but you don't have that flexibility.
Right. So yeah, it's just a cool flexibility. Yeah, I think that's worth giving some consideration to. So
yeah, I have one last note on dividend strategies and a way that they can be used.
Yeah,
we've touched on it in the past. I have custodial investment accounts for each of my children that we invest money into each month. What I have done with those accounts is ensure that everything within the accounts, all the equities that have been purchased, all the different index funds, etc., the ETFs, they are either geared towards growth or qualified dividends. I don't want any kind of ordinary dividends or ordinary income paying into those custodial accounts because they are taxable. And for anyone who has looked into it or who has kids or who is considering possibly investing for children in the future, Congress really doesn't like parents investing large amounts of money for their non-adult children. So your children can earn $1,300 generally tax-free. That's the deduction that can be earned within a custodial, a child's investing account. Then you have another $1,300 at the child's tax rate. And after that, after you exceed that $2,600, your children are taxed at the parent's nominal tax rate for any income that's received within that account. So depending on your personal tax situation, let's say that you were in the 0% tax bracket. If your child's account is loaded up with qualified dividend equities and you would pay 0%, then theoretically your child would also pay 0% on that qualified dividend income within that taxable account.
Interesting. Yeah, it's called the kitty tax.
Yep.
Not to be confused with our feline companions.
No. No, sir.
That
did not work.
It was impossible to resist that pun.
Moving on.
Meow that I've said that. Let's continue.
Get on with this right meow.
So, anyway, listeners,
I don't know if anyone's ever seen Super Troopers.
Yes, it's an amazing scene. So, some closing thoughts in case our listeners haven't left after those horrible puns. Just as a quick recap, most people investing in the stock market, broad index funds, are probably exposed to some qualified dividends depending on their holding period, right? It's a popular idea. A lot of people are really promoting this idea of dividend investing, and we wanted to talk about it. So take what we said today with a grain of salt. Look at the pros and cons, but don't get carried away with any one idea, right? Qualified dividends are just another tool in the tool belt that you can employ and consider to see if it fits in your overall tax planning strategy. Be honest with yourself if it fits with your investing style and your financial plan and your allocation risk tolerance. I think that's why it's important to work with professionals to seek advice on this kind of stuff, investments and tax, to make sure that your style, your risk tolerance, your personality, your investment behaviors or financial behaviors, your tax situation, that all of those things align and are working in coordination with one another. I think the risk here is just don't get sucked into any one single idea, because if you go too far with any one single idea, even if it's a really good idea, it can imbalance your plan. It can bring imbalance to the equation. So
focus on some of that diversification that we talked through and flexibility, right? Having those different buckets and tax diversification options can allow you to make better moves, far into the future for things you may not have foreseen.
Yeah, agreed. Yeah, well, I think that's it, Danny. To our listeners, thanks for joining us today on a nerdy talk about qualified dividends. Hope you enjoyed it, and we'll see you next week.